Okay, so I want to welcome everybody that is on board here to the second in a series of our new normal of real estate webinar series. On behalf of my partner Shannon, I am Michael Collins and presenting today's webinar. This is a second in a series of what we call the new normal series, my computer's running a little slow, so bear with me here. We're trying to provide you with specific, viable, current information about real estate, all things real estate. We're all hearing a lot of news today about what's going on, both with the global economy, the local economy, and how they interact. And of course, the housing industry and real estate is a big part of that. So we're trying to find experts that can talk specifically about real estate-related items. Today's discussion is going to be how to buy real estate with your IRA. To be more specific, how to invest in real estate with your IRA. Today's discussion will be 35 to 40 minutes. That's what we're planning. We're asking you to type in questions as you go, and we will answer them at a Q&A session towards the end. Today is sponsored by Timothy Schubert with Farmers Insurance. He's no stranger to self-directed IRA. So Timothy, tell us a little bit about what you know about self-directed IRA, how you're using them personally, and then of course talk a little bit about Farmers Insurance.
Okay, Michael, thank you very much for allowing me to be part of this today. Again, my name is Timothy Schubert. I am an insurance agent with Farmers, which is about in the last 12 months that has happened. Prior to that, I worked in the self-directed IRA industry for the last 20 years. I not only understand this strategy, but I practice it. I have 2 rental properties with my IRA, and so I understand how this process works. I've helped hundreds of people understand this concept, and so I have a little bit of background in this as well. So today our presenter is going to be Lamar Baxter. He has been with AccuPlan Retirement Benefits. I have had a long-standing relationship with Lamar, and I help him with his clients as well, and we have a great relationship together, and he's an expert in the field, and I appreciate him as well. I want to go ahead and turn this over to Lamar so he can go ahead and start his presentation. And also I wanted to say with Farmers, we do have the ability to help folks with their rental properties to insure them, and so Farmers is one of the few insurance companies out there that does insure rental properties and help folks with that, and not only rental properties but also renter's insurance for your tenants, so we can help with that as well. Lamar, thanks a lot for presenting today, and I'm going to turn it over to you.
Thanks a lot. Thanks a lot, Timothy and Mike. I'd like to thank everyone for attending today's webinar. My name is Lamar Baxter. I'm the Director of Business Development for AccuPlan Benefit Services. Today's session, we're going to be covering how to invest in real estate using your self-directed retirement plan, in particular self-directed IRA or 401k. Today's discussion is going to be a brief overview in terms of how the self-directed plan works as it relates to purchasing real estate. We're going to discuss the rules. We're going to discuss process and procedures to make sure that when you're moving forward within the transaction that it's compliant, both at the start as well as throughout the transaction process while your IRA or 401k owns the property. Just a little bit about myself. I have over 28 years of very financial experience, including real estate investing, as well as both real estate investing, sales experience, as well as a previous real estate investment broker, or I should say real estate loan broker. So a lot of the transactions that come across my desk relate to my past endeavors as it relates to my career. In addition to me, once again, having experience in that area, I actually practice what I preach. So I actually have both the self-directed SEP and Roth IRA, where I own both property as well as secured deeds of trust and notes. So once again, unlike maybe some of your other real estate or I should say financial professionals, I'm actually practicing what I preach. I believe that much in this product. So before we get started, just want to kind of go over our disclaimer. Our purpose here today is to provide education. It's not to endorse or promote any in particular investment. It's really to get you to understand the power of this tool and how it's used. So with that being said, the information today is provided is based on educational information. I would suggest that you always contact your tax professional as well as any legal professional before moving forward in any investment endeavor to make sure that everything's in order. Just a little bit about AccuPlan. We're a national company. We have offices throughout the U.S. Our primary purpose is to provide self-directed IRA, 401k, administrative, and custodial services. We have a very expansive, should I say, staff as it relates to making sure that your transactions are compliant and that we're providing education and information to make sure that your transactions are as seamless as possible. Before we get started, what I like to do is kind of give everyone an overview as to why most of our clients have chosen a self-directed IRA, as well as those are looking to, in the future, look to this investment tool to grow their retirement account. It's estimated that 10,000 baby boomers per year, for the next 20 years, will turn 65. Of that population, is up to 75% of that population will not have enough resources to retire at the age of 65 and beyond. In addition, most will be forced to continue to work beyond that age of 65, provided that their occupation will allow them to continue working beyond that age. That same population will face skyrocketing health care costs, diminished Social Security, as well as Medicare benefits, and of course to factor in the aging population, long-term care costs. I know I've spoken with a client that never factored in the fact that they would maybe have to take care of their parents and had to put one of their parents in a rest home, or should I say care facility, in which it can range anywhere from $6,000 to $10,000 per month. And I'm sure most of us, in most cases, don't plan that would happen, but that is happening more often than not. So you definitely want to make sure that you're gearing yourself towards those fixed costs that may come down the road to make sure it does not erode your retirement nest egg. Inflation, cost of living increases will also threaten to erode your fixed retirement income. So once again, factor in the fact that we're going to always have inflation and cost of living increases, so you want to make sure that you have adequate funds to carry you through your retirement years. It's estimated over $5.7 trillion in both IRA and 401k funds are out there in investment vehicles, but only 1% are actually invested in alternative investments through a self-directed retirement plan. So hopefully the information I'm going to share with you today is going to change that mindset to kind of give you an idea of the wide range of investment options you have available to you, including real estate. It's up to 70, or should I say 90% of the population is unaware that a self-directed plan exists. That would also include your attorneys, your accountants, as well as some of your financial planners. And in all due respect to the financial planners and advisors, it's not an area that they specialize in or have the expertise. So a lot of times they're not aware that this area of investment is also has been around and available to investors since 1975, part of the IRA Act that passed that allowed you to go beyond just your traditional Wall Street investments. Your current custodian may not offer what's called a truly self-directed IRA. Self-directed is kind of a generic term, so you want to make sure when you're shopping around for a custodian that when you're looking to obtain a self-directed plan that you have access to invest in to every investment class with the exception of life insurance and collectibles. The best question is, if you are looking to shop for a custodian, ask them, can your IRA or 401k directly own real estate? If the answer is no, usually it's not a truly self-directed plan. As I mentioned, diversification is the key. You want to make sure that, like I mentioned earlier, I didn't change one of the numbers, there's over $5.7 trillion in assets, most invested in Wall Street investments. And we've all been led that's the best way to go, but once again, there's a wide range of investment options that's available to you. So diversification, like I said, is not to steer you away from traditional investments. Most of our clients are invested in both traditional and non-traditional investments, with I would say real estate being the number one asset class, taking up maybe 60 to 75% of most of our clients' funds when it comes to investing, because once again, real estate, unlike any other investment, is usually a secured investment. We all remember what happened in 2007, 2008 when the market took a crash. It's nice to know that in the event if there's any adjustments in the real estate market, your entire investment will just not evaporate. So that being said, a lot of our clients have opted to move towards real estate as the ideal investment option within their portfolio to make sure that they don't lose their entire nest egg. Precious metals and other types of investments are available using a self-directed plan. Private notes and loans, once again, going back to what I alluded to earlier, I personally choose to invest in private notes and loans secured by deeds of trust. For me, it's less labor intensive. In the past, like I said, I have owned real estate in my self-directed plans, but based on what's going on in my life and just how busy I am right now, it's just a lot easier for me to invest in private notes. In addition to private notes, you also have the ability to invest in companies. Also can be real estate related. So there's a lot of different options you have available to you, as well as structures being able to use this investment tool. Our model in the self-directed IRA industry is invest in what you know and understand. And just kind of give you an idea how wide of a range of options you have for for investing. If you were to look at this list, or should I say pass this list along to your current custodian that is not a truly self-directed plan, and ask them, could you use your funds to invest in any of these asset classes, I'm sure the answer would be no. That being said, it's usually because their plan agreement limits them to specific types of investments, not always including alternative investments. So the sky's really the limit. With the exception of life insurance and collectibles, you really have a really wide range of options when it comes to investing your retirement funds. We're going to talk a little bit about some of the rules that have to be followed to make sure that you're investing in a compliant manner. And our role as a custodian and administrator is to make sure that we're providing you with education and information to make sure that your transactions are compliant. So the first one we usually want to talk about is prohibited transactions as relates to IRS Code 4975, basically stating that there cannot be any dealing between your retirement plan and yourself personally along with other parties. And we'll talk about who those other parties are considered to be and what the role that you have to take on as the account holder to make sure that your transactions are compliant and you're not working with what they call disqualified persons. So some examples of a prohibited transaction would be any disqualified person, we'll talk about those disqualified persons on the next slide, are prohibited from engaging in any transaction that involves selling, exchanging, or leasing property, lending money, extending credit, and so on and so forth. So the main objective is to make sure that the relationship between your IRA funds and yourself has to be arm's length, which is why we as a custodian acts on the behalf of your IRA to administer all your transactions to make sure you're compliant with IRS rules. So in essence, you want to make sure there's no self-dealing and no personal use. And that's really important when we talk about investment in real estate. I know the question comes up a lot is, well, if I was to invest in a piece of property using my IRA, can I ever live in it? Not while the IRA or the 401k owns the property. However, once you sell the property or do you decide you get beyond retirement age 59 and a half, and you decide you want to convert the property into your name, which is in the form of a distribution, you can do that, and at that point you can move into the property. But as long as the property is owned by the retirement plan, you cannot live in the property, nor could any other disqualified parties. And speaking of disqualified parties, we're going to go to the next slide to kind of give you an idea who those parties are. So a disqualified person would be yourself, your spouse, parent, grandparent, children, or grandchildren. So in addition to the relationships, should I say the relatives that I just mentioned, any fiduciary of the IRA, anyone providing services to the IRA, any direct ownership or indirect ownership of any corporation where you own more than 50% ownership stake is also considered a disqualified person and or entity. So the question towards the latter bullet is, well, what do you mean by that? I have clients who have existing businesses that they own, and opposed to go to the bank to obtain a loan, they may opt to maybe consider loaning money from the IRA or 401k to the business. As long as that entity, or I should say that individual, does not have more than 50% ownership stake in that entity, that corporation, LLC, whatever the case may be, and they do not have majority decision-making power in that entity, they have the opportunity to be able to grant or to conduct business with the IRA or 401k as long as they meet those parameters. For more information on that, feel free to give me a call or email me if that's something you're considering. So in essence, you really want to make sure that you do not mess with the IRS. The IRS has been taking a closer look at certain investment vehicles, in particular the self-directed plan, because there have been abuse in the past, and of course, because it's becoming more and more popular, they feel that they're losing money in terms of tax revenue, so they want to make sure that everyone is compliant to make sure that there's never a taxable event, which will also result in some penalties if it's basically a prohibited transaction that occurs prior to retirement age, which is 59 and a half. So we talked a little bit about the rules, so you definitely want to make sure as you're structuring your investment transaction or you're speaking with someone regarding a transaction that you're following those rules. I do have a PDF that I usually send out to my clients as well as anyone that they're working with that they can review and basically reference to make sure that as they're putting together their transaction, they are following the rules. So how do you actually get funds into the account once the account's established? So you have 4 different methods of actually funding your account. The first method is usually transferring funds, usually from an existing IRA custodian. Usually transfer is usually synonymous with an IRA to IRA transfer. Usually it's no taxable event because you personally are never taking possession of the funds. The funds are coming directly from your existing custodian over to us. Usually it takes anywhere from 7 to 10 business days, but that time frame could vary depending on your custodian's time frame to process the request to get the funds dispersed out to us, whether it be check or wire. The next method is to use a rollover method. Usually can be done either with an IRA or a 401k or an employer-sponsored plan, usually a plan from a previous employer. You have the option to take possession of those funds where they'll send the funds directly to you or they'll send them to us. A rollover usually allows you to move the funds between custodians within 60 days. It is a taxable event, but once the receiving custodian receives the funds, whatever amount is received, hopefully it's the full amount. If not, whatever amount that's not actually transferred over to us or rolled over to us, we'll generate a 1099 at the end of the year. So within 60 days, those funds have to reach another custodian or you will receive a 1099 at the end of the year for that full amount. Contribution. The other way, once again, to put funds into the account in addition to the transfer and rollover is out-of-pocket funds. Depending on what type of plan that you choose or you're eligible for will determine what your contribution maximum is. And you definitely want to be consulting with your tax professional as it relates to what your contribution limit is. It's no such thing as a one-size-fits-all. Everyone's financial picture is a little different, and there's a such thing as a modified adjusted gross income, which can determine what is your maximum contribution limit each year based on your modified adjusted gross income for that particular tax year. So we'll talk about the different plans on the next slide in terms of to give you an idea which plan would probably be best for you and what your contribution limit would be for that plan. The last one is a conversion. A conversion involves moving which is called tax-deferred funds, usually from an IRA or 401k, a traditional IRA or 401k, or maybe even a SEP IRA if you're 1099 or self-employed, over to a Roth account. A lot of our clients are worried about what the tax rates are going to be at retirement. So opposed to opting to determine that they may be at a higher tax rate at the retirement age, many of our clients are looking to convert from a tax-deferred status over to a tax-free status by transferring those funds into a Roth IRA. The downside is that you pay taxes now, but hopefully you're paying taxes at a lower tax rate than what it may be in 10 or 15 years. And it's nothing worse than enjoying double-digit returns on your investment only to find out that you're going to be facing a much higher tax rate at retirement age. So definitely something you want to sit down with your tax professional to determine whether a conversion is available or should be the best route for you. A conversion can be done. You can do a complete conversion of all your funds, or you can do partial conversions. Not everyone wants to take that tax hit, so you do have the option to convert small chunks of your funds to meet an objective, eventually get all of your funds into that Roth account. Once again, you want to sit down with your tax professional to discuss that strategy. So as we just mentioned, all of our plans, we do have various types of plans that are all self-directed. So what we're looking at are the different plan types. In addition to the plan types, we're looking at the contribution limits for the year 2015. And these limits, in terms of contribution limits, are up to the maximum. Once again, even though it shows, for example, in the traditional IRA, the maximum is $5,500, you may be subject to a lesser contribution amount depending on your modified adjusted gross income. So you want to make sure that you're consulting with your CPA or tax professional each year to determine what that maximum amount is, because there is a 6% excessive contribution penalty if you contribute more than what you're allowed for that tax year. So just kind of go real quickly through the different plan types. The traditional IRA is a tax-deferred account. For those who usually are individuals who may not have access to an employer-sponsored plan, you can be either 1099 or W-2 to be able to open that type of plan. The Roth account, same contributions as the traditional IRA. The difference between the Roth IRA and the traditional IRA is that it is a tax-free account provided you've met 2 milestones. prior to or at the time of age of 59 and a half when you start to take your distributions. Those two milestones that you have to be at least 59 and a half, and you've had the account for at least 5 years, not that specific account, but had a Roth account for at least 5 years. So you may have a Roth from a previous custodian. The clock starts from the time that you open your very first Roth. So as long as you met the two milestones of 5 years and you're 59 and a half when you start taking your distributions, you pay no taxes on the gains that you had derived in that particular account. So you can kind of get an idea why this account type is becoming a really popular investment vehicle based on some of the factors I mentioned on the first slide. SEP IRA. This is for those who are 1099 and or self-employed. As you see, the contribution limit is much higher. It is a tax-deferred account. The only account on this slide that is tax-free is the Roth, unless we talk about a component within the 1K or the solo K, which we'll talk about briefly in a short period of time here. The simple K, or should I say simple IRA, is for those small businesses with 100 employees or less. You're able to contribute up to $12,000 into that plan, as well as your employees. So you may have a small business opposed to opting to go with the 401K for your employees. You may opt to go with a simple IRA, basically giving your employees the added benefit of being able to have a self-directed plan to be able to invest in alternative investments. As you may see, the contribution limit's not as high, but once again, it's an opportunity and a least expensive way of offering your employees the opportunity to have a self-directed plan. The 1K or the solo K, this usually is something that's usually compared, the plan is compared to both, usually to the SEP IRA. If you notice, the contribution limits are identical. The nice thing about the 1K is there's some variables, some benefits that's nice with the solo K that are not available with the SEP IRA. One being is that you can borrow from a 401K or solo K. An IRA, you cannot borrow from it. So that's one of the caveats as it relates to comparing the two, which to go with is that you're able to borrow up to $50,000 from that plan, and you have up to 5 years to pay back that borrowed amount. Pretty much the same rules you would follow in terms of borrowing money from a 401K from one of your employer-sponsored plans. You have that option with the solo K. In addition, if you're looking to take on what's called a non-recourse loan for real estate investing, this plan, because it has an employer-sponsored component, is exempt from what's called unrelated debt finance income tax. On any IRA, if you were to take out a loan in the name of the IRA, you're going to be subject to unrelated debt finance income tax on the amount borrowed. Once again, the solo K is exempt from that tax, so that is one of the things you want to consider if you're stuck between going with the SEP IRA or a solo K. So we're going to talk real briefly about some investment options and structures, so which Tim is going to be talking about towards the very end of this slide, the presentation. Partnering via an LLC, you have the option to invest in what's called a single-member LLC or a multi-member LLC. Depending on which option or direction you want to go with the structure of the transaction will determine which LLC structure will be best for you. A non-recourse loan is a type of loan that is granted to the IRA that is separate from any credits that you may have. You're exempt from basically having to produce any type of credit or asset history because the loan is actually granted to your IRA. And some would say, well, what bank would actually loan to this type of transaction? So what it is basically allowing you to do is put up a certain amount of money out of your IRA or 401K that will serve as your down payment, and most of these lenders will usually lend up to, say, 65% loan to value. And the reason that they are usually able to do this is because they're looking at if you have 50 to 60% skin in the game, then it's not so much of a risk if you was to default on the property. And non-recourse meaning that in the event of default, the only recourse the lender has is against the subject property, not against any of your other assets, not against any other assets in your IRA. So that's kind of an asset protection component to that transaction if you're looking to go that route. I know in the past, say in the last 5 or 6 years, a lot of our clients have inquired about the non-recourse loan, but really weren't able to find a lot of lenders. A lot of lenders kind of gone off to the sideline back in 2007, 2008, but the good majority, if not all, are back in play in terms of offering these types of loans. If you like, I can actually email you a courtesy list of those lenders that are lending nationwide, and you can contact them to determine what their rates and terms would be on that type of loan. The New Deal exception. I mentioned earlier that you're prohibited from doing business with certain disqualified parties. Now, there is an exception to that rule, meaning that in the event that you're looking to purchase a piece of real estate and you want to partner using your personal funds along with your IRA funds, or your IRA funds along with the spouse's IRA funds, as long as the property was not previously owned by your spouse or yourself or currently owned, you can actually partner retirement funds with other retirement funds of the spouse or other disqualified person, or even personal funds, to go in through a tenants in common structure to purchase the property. There are certain rules, as I mentioned, that has to be followed. Once the transaction closes, neither party within that transaction, that tenants in common structure, could ever buy each other out. They would have to sell that property, and the income and expenses throughout the transaction will be split in accordance to the percentage of ownership between the two parties. So that's something really important, that where if you're going to go that route, you want to make sure that you're sitting down with someone that you guys have a mutual objective in terms of how long you're going to own the property, and that you guys have the adequate expenses to be able to cover your portion of the expenses to maintain that property for the duration of the time that you own the property in that tenants in common structure. For more information on that, feel free to give me a call or email me. So, real simple process to get this process going here. What you want to do is, first step is to establish your account. We can usually get an account set up within 24 hours. We offer the ability for you to establish your account online. In most cases, if you do it online, we can actually have it set up the same day, provided you provide us information that we require, such as the transfer form as well as your ID. We can get everything set up that same day. The next step is to fund your account. As I mentioned, you have 4 methods of funding your account. In most cases, you're going to be transferring or rolling over funds from a previous retirement plan. As I mentioned, it takes anywhere from 7 to 10 business days to get those funds transferred over. Once your funds are actually in your account, you're able to now go into contract and move forward with an investment. It's really important, which we do provide a checklist to both the clients as well as to the parties that they're involved in, usually the real estate agent, escrow agent, to make sure everyone is aware of what's required on that checklist that we need. In most cases, if you're the account holder, you should have a real estate agent who should look at this checklist and pretty much adhere to everything on that checklist. So once again, it's nothing that you personally have to worry about. Your responsibility as the account holder is make sure that you're hiring a competent real estate professional who can execute this transaction on the behalf of your IRA. Once the documents are completed, usually we can get everything turned around. We have a complete and error-free packet to get everything closed within 3 to 5 business days. Usually what you want to make sure, and the reason why we say establish your account as the number one bullet here, is to make sure your account is established, because you cannot go into contract under your name and then transfer it via an addendum. It is considered a prohibited transaction, so you want to make sure you at least establish your account, which we will assign you an account number investing to allow you to go into contract. We don't require that you per se that you're able to go into contract until the funds are actually arrived, but in most cases the selling agent is usually going to see proof of funds, and what they're going to be requiring is proof of funds from your self-directed plan. They don't want to see a statement from your Charles Schwab account indicating that the funds are en route to your AccuPlan account. So you definitely want to make sure your account is both established and funded, because it's pretty competitive out there in a lot of transaction scenarios. So you don't want to lose a great deal because your account is not both established and funded. So once the documents are submitted, all the third-party documents, usually 3 to 5 business days, we can basically get everything signed, returned, and everything closed. So real quickly, here's a visual in terms of what the transaction process would look like. Once again, opening your account, funding it, select your investment, and we fund the investment. That's simple. Despite what you may have heard from other parties who've never done this, it's not that convoluted. Like I said, this concept has been around since 1975. It's become real popular as a result of a lot of people losing monies in the market back in 2007, 2008. Quick summary. IRAs can hold all types of investments, not just securities. So once again, you want to continue to diversify your portfolio, both of traditional and non-traditional investments. Partnerships and split ownerships are allowed. We talked briefly about tenants in common transaction structures, so you have different structures available to you. You just want to make sure that we're communicating to make sure that it's compliant. That is my role, to make sure that your transactions are compliant. So you definitely want to run this scenario by me to make sure everything's in order. IRAs and solo K plans can grow tax-deferred or tax-free. Depending on what your objectives are for paying taxes now or later. You want to sit down with your tax professional to determine which plan is best for you. All plans qualify for partial transfers and partial conversions. As I mentioned earlier, you may not want to take on the option of converting your full account because of the full tax hit. You can also do partial conversions. Partial transfers, that's usually available to, as it relates to an IRA to IRA transfers. You can move all or a portion of your funds. You're not required to move all of it. However, an employer-sponsored plan such as a 401k, you're usually required to roll over all the funds from a previous employer. That would be the exception. But once again, IRAs, you can do partial or full transfers. Self-directed IRAs will play a critical role in crowdfunding. It's something that that's kind of a new emerging area in real estate that's affecting real estate, to where you're going to be, you're actually currently allowed, depending on what your status is, to public solicit funds for different types of investments. And of course, real estate being one of those investments, there's a lot of players out there now that are going through crowdfunding platforms to be able to raise capital. So you'll hear a lot about that, and the self-directed plan will be playing a critical role in that transaction. As I can't emphasize enough, be sure to establish and fund your account prior to entering into contract, because I've seen too many times where the transactions, should I say, an investment opportunity was lost because the account was not both established and funded in a timely manner in order to go into contract. So that's my presentation for today. Here's my contact information in the event you have any questions as relates to what I covered today, or if you want to ask more detailed questions relative to a specific transaction, I'd be happy to answer any questions you may have. So we're going to just go ahead and turn this back over to Michael and go into our Q&A session. I'm going to transfer this back over to you. You should have it any minute here.
While we're doing this transfer, Timothy, can you take just a few minutes to talk about checkbook control after what all this great information that Lamar just rolled out?
Sure. One of the strategies that Lamar mentioned was investing your IRA into an LLC. That's also commonly known as checkbook control of your retirement funds. What that basically means is that it's pretty simple. You invest your IRA rather than into real estate. We would create a limited liability company for your IRA to invest in. So as far as AccuPlan is concerned, or your custodian is concerned, the asset that you've invested in is a limited liability company. We would name you to be the manager of that LLC. When your LLC is all created, your account has been funded at AccuPlan, you would give them instructions to invest in the LLC. They write a check out of the LLC payable to the, out of the IRA, payable to the LLC. They would hand you the check because you're going to be named the manager of the LLC. You take that check into your local bank, open a checking account in the name of the LLC with its own tax ID number, deposit that check, and your banker turns around and hands you a checkbook. Now, when you're ready to go buy investments like a piece of real estate, you would do it in the name of the LLC. The LLC owns that piece of real estate, and you're the manager of it. And so you would manage all of the transactions that happen. At the closing table, you're the one signing on behalf of the LLC because you're the manager. And when you need to remodel it or do plumbing work or whatever it is, you write the check to the plumber. You handle all of that, and the custodian is out of the picture when it comes to that, saving you, most of the time, saving you money and fees. That's a short synopsis on how checkbook control works, but that's how I manage all my retirement accounts. I have checkbook control of my funds. My real estate that I do have is owned by my IRA LLC, and we manage those ourselves.
Thank you, Timothy. I have a question for Lamar. In the past, when we used our IRA, we started to look to doing a loan, a construction loan, using on a property that we were in fact investing in. We were going to be able to get an unsecured loan. However, he still wanted us all to sign off on it personally.
Yeah, so that comes up a lot, and this is where a lot of times I mentioned that I have a courtesy list of non-recourse lenders, and of course, an individual will become a non-recourse lender. So what you're going to run into is, in certain cases, whoever's drawing up that promissory note needs to have language indicating that it is a quote-unquote non-recourse loan. As I mentioned, in the event of default, the only recourse is against the against the property and not against the IRA. And it kind of goes to the question you're asking. It's prohibited for you as the account holder to sign off in any capacity on that loan, in addition to co-sign on that loan. So if you ever have a situation to where someone is basically urging you in order for them to do the loan that you have to personally sign off, you cannot do it. You're going to have to kill the transaction if they're adamant about you signing off personally, because what they do is put you directly at risk of having your entire account disqualified, because you personally signing off in any capacity, either directly or indirectly, is considered a prohibited transaction.
Wow, I'm so glad I didn't do that.
Yeah.
We have a question from Shannon saying, if I invest with my self-directed IRA, can I hire my nephew to do repairs?
Yes, you can. As I mentioned, the disqualified persons are yourself, your spouse, parent, grandparent, children, and grandchildren. So anyone who's on the horizontal line of the relationship, brothers, sisters, aunts, uncles, cousins, nephews, those are not considered disqualified parties. So you have free reign to be able to do business with those who are not considered disqualified parties.
And what about if she just wanted to pay him cash? Is that okay to work on the investment property that she's purchased?
Well, what you want to do is, one of the things that is covered in our responsibility as a custodian is IRS reporting and record keeping. You want to make sure there's always detailed account of any monies coming in the account or going out. So paying cash would not be permissible. However, if you were doing an LLC and you wanted to cut a check to that individual, once again, you're not paying them cash. There's a record of monies being dispersed out for a specific function, and you want to be real clear on that. And as a custodian, if you're doing business directly out of the IRA, we require that an invoice, even if it's someone just basically handwriting an invoice, whatever the case may be, they have to actually generate an invoice, bill to the IRA vesting, in which we will cut a check. If it's an LLC and you're the manager, you want to make sure that you follow those same rules, because what will happen, and Timothy will confirm this, is that in the event that there's an audit, the IRS is going to look very closely at that LLC, because there has been abuses on the behalf of certain account holders misusing funds or basically commingling personal funds. So you want to make sure that you have detailed accounting records of incoming and outgoing funds and the reason for it.
Okay, I'm trying to launch a poll now and find out, because Shannon and I are trying to figure out. Oh, I'm getting some response. So I guess it was launched. First time I've done the polling, but we're trying to find out the best times for doing this these webinars, and also the best day of the week. And also, we'd love your input. All the attendees will get an email tomorrow. We'd love your input on what we can, in fact, do to present a new webinar that you might have some interest in. In other words, if you've got subject matters that are important to you, please let me know. Please let us know. Upcoming webinars that we have on February 26th, we're going to have Creating Financial Freedom Through Real Estate. This is going to be a continuation of this discussion. We're going to take it from a different posture, though. We're actually going to be talking about income properties and areas of the valley which people might want to invest in properties. Coming soon, without any specific dates yet, we want to do one called Green Living. I'm a green designated real estate broker, and Shannon and I are really trying to get more people to consider buying homes that are with solar panels and all the green features. You're starting to see solar panels everywhere. Also, for a while, we've had a dynamic program for teachers, military, vets, first responders. They can actually save money on buying or selling their home. So we're going to do a workshop on that for this very special category of people. So we want to thank everybody for attending today's webinar. Thanks to our expert, Lamar Baxter, Director of Business Development at AccuPlan. Lamar, you did a great job.
Thank you.
And Timothy, always a pleasure. You were one of the first people I saw do a presentation about self-directed IRAs that stuck with me, and now my wife and I are involved full tilt, so we're excited about it. I appreciate you sponsoring today's event. And if you need some insurance, Timothy's the guy to go to. He's a great guy. Highly recommend him.
Appreciate that, Mike.
So on behalf of my partner Shannon Collins and the entire MoveUpAZ team, I want to thank you for participating in our second webinar series. You guys were awesome in attending, and we appreciate it, and appreciate everybody participating as well. So this will be the end. See you on the 26th of February. Thank you, everybody.
Thank you.